Welcome to this edition of Traders Academy, where we're going to discuss the introduction of exchange-traded funds, or ETFs. My name is Michael Barrer, Associate Director of Capital Markets at WisdomTree Asset Management. At Capital Markets at WisdomTree and all of the ETF issuers around the street, we are in charge of the ecosystem of trading for ETFs. So ETFs are exchange-traded. We manage the trading relationships, the broker-dealers, the market makers, the authorized participants, and the exchange relationships. We are also in charge of managing the intermediaries like interactive brokers and all the platforms that our investors trade through. And on top of that, we marry all of that education together and work with our end clients and investors across all different client segments on educating them on ETF structure, trading, liquidity, and best execution practices. So today we're going to discuss what is an ETF, how does it differ from a mutual fund, what types of ETFs are available in the marketplace, what is an index and how does that differ from an ETF, and where are ETFs traded and the basic structure around ETFs. So let's get started and talk about what is an ETF. An ETF is a 1940 Act exchange-traded investment wrapper that tracks a basket of securities, very similar to a mutual fund, but it is exchange-traded. Most ETFs are designed to replicate and track an index, although some are also tracking, they are not tracking an index and they are actively managed. ETF investors do not interact directly with the ETF exchange company, whereas they trade ETF shares on an exchange, and the authorized participant, through the creation redemption mechanism, which we will get into a little bit later in this presentation, is the one that is interacting directly with the exchange-traded fund and the exchange-traded company to bring assets in and out of the fund. So how does an ETF differ from a mutual fund? Well, let's talk about buying and selling. ETFs, as we said, are traded on an exchange intraday. Mutual funds are traded through the mutual fund company, and they are traded once a day at NAV. Transparency. ETFs holdings are published on a daily basis, and they are transparent at all times. Whereas mutual funds are published, their holdings are published on a quarterly basis, and that quarterly basis is generally on a 30-day lag. Minimum investments. ETFs is one share. So whatever the price of the ETF is, that is your minimum investment. Whereas in a mutual fund, mutual funds tend to have higher minimums depending on the share class. So it is a little bit different, and you tend to have to invest a little bit more into a mutual fund. Transparency of trading costs. ETFs trading costs are borne by each individual investor, and that is transparent through the bid-ask spread that you see on exchange. Costs of trading for a mutual fund are borne by all investors, as the trading costs are wrapped into the NAV every single day, and all investors in a mutual fund share in those trading costs. Tax efficiency. ETFs are a more tax-efficient vehicle because of the technology of the creation redemption mechanism, which we will talk about, where mutual funds are less tax efficient because all of the trading to bring assets in and out of the funds are done inside the fund by the portfolio manager. Expense ratios. ETFs generally tend to be less expensive vehicles, and mutual funds typically have higher expense ratios and vary depending on share class. Liquidity. ETFs have daily liquidity and they have intraday liquidity. So as long as the exchange is open, you can trade in and out of the fund, whereas in a mutual fund, you can get in and out of the fund one time a day at NAV. So what is an index? An index is a hypothetical portfolio of investment holdings which represent a segment of the financial markets. They are typically a benchmark index, such as the S&P 500, the ACWI MSCI World Index, the DAX index in Europe, also the Russell 2000 Small Cap Index in the US. You cannot invest directly into an index. You must use some other sort of vehicle that tracks that index. And that is initially how ETFs were designed, and most ETFs do track an index. So again, you cannot invest directly into an index. You must invest into a tracking vehicle such as an ETF. Now, the difference between the ETF and the index in a perfect world is called tracking error, and that tracking error difference between the return of the index and the ETF will be that fund's expense ratio.